Hey there, curious minds. Ready to crack the code on how global money really moves? Today, we're diving into international tax issues. Now, I know tax can sound like a bit of a snooze maybe, but trust me, this deep dive is packed with surprising insights. It's a high-stakes game played by companies and countries all around the world.
Absolutely. Yeah, our mission today is really to pull back the curtain, show you how businesses and individuals too navigate this incredibly complex web of tax systems across different nations. It's a constant dance really. Rules, strategies, all designed to ensure ideally everyone pays their fair share no matter where they operate. And we've got a really comprehensive set of notes here to guide us through this intricate landscape.
Okay, let's unpack this fascinating world then. Let's start with a classic maneuver, something that can have huge tax implications. How companies price things when they sell stuff internally, across borders. Right, here's where it gets really interesting. Imagine a massive global company, let's call them Global Widgets Inc. They've got different parts of their business scattered across the globe, like maybe a factory in one country, a distribution center in another, and a sales team in a third. They're all part of the same corporate family, right? So what happens when the factory, maybe it's in a low-tax country, sells widgets to the distribution center in a medium-tax country, and then that center sells them to the sales team in a high-tax country before, finally reaching the customer? How do they set those internal prices?
Exactly. This is really the heart of transfer pricing. An affiliated group of businesses, like our Global Widgets Inc., they could technically set up these internal sales prices, these transfer prices, in a way that shifts profits. They could move them from high-tax countries to low-tax countries. And this can, sometimes intentionally, sometimes not, reduce the income reported in certain nations, including the U.S., which means, naturally, less income tax collected by those governments.
Ah, okay.
So to really see this, let's stick with our Global Widgets example for a sec. Imagine their U.S.-based holding company owns three subsidiaries. There's M Company, the manufacturer. Let's say they're in country M with a super low 10% tax rate.
Okay.
And finally, R Company, the wholesaler, in country W, maybe 20% tax rate. And finally, our company, the retailer right here in the U.S., facing a, let's say, 30% tax rate. Now, M Company makes a widget for just $1 cost.
Right.
And our company, the U.S. retailer, eventually sells it to the end customer for $9. So there's an $8 profit margin somewhere in that chain. Now, if Global Widgets could just do whatever they wanted, ignoring the tax rules for a moment,
Which they can't, I'm guessing.
which they definitely can't. But hypothetically, they'd want to report as much of that $8 profit as possible in country M, right, where the tax rate is only 10%.
Yeah.
So maybe M Company sells the widget to W Company for like the full $9.
Okay.
Then W Company sells it to R Company for $9. And R Company sells it to the final customer, still for $9.
So wait, M company in the 10% tax country gets all the profit, and W and R companies show zero profit, pay zero tax in their countries. That sounds, yeah, a little too convenient.
Precisely. In that scenario, M Company reports an $8 profit that's the $9 sale price minus the $1 cost. They pay only $0.80 in tax. Net income, $7.20. Country M is happy, obviously. But the U.S. tax authorities, the IRS, and Country W, they are definitely not pleased. They collect nothing from this group.
Right, because all the value seems to have magically appeared in the low tax place, so the IRS wouldn't stand for that, clearly. What can they actually do?
This is where the tax code, specifically sections like 482 and 6662, gives the IRS significant power. They can essentially adjust the income and deductions, including cost of goods sold, of these related companies. They do this to prevent tax evasion, or even just to clearly reflect the income where it's actually earned. They can even impose penalties if it looks abusive.
Okay.
So in our widget example, the IRS would most likely step in and say, hold on, our company, your cost for that widget wasn't really $9.
Yeah.
They'd reduce our company's COGS, which forces our company to show a profit and consequently pay U.S. tax on that profit.
And how do they decide what the right price should have been?
That's based on a fundamental principle called the arm's length standard.
Arm's length, okay.
Think of it like this. The IRS wants to make sure that transactions between related parts of the same company, controlled transactions they call them, are priced as if they were dealing with completely independent, unrelated companies, like at arm's length.
Got it. Not just shifting profits around within the family.
Exactly. The goal is to figure out the true taxable income that would have been earned if these companies were operating independently in the open market.
Okay, that makes perfect sense conceptually, but how do they actually determine that arm's length price? Sounds like it could get complicated.
It definitely can be. They look for comparable transactions. Basically, what would independent companies charge in similar situations under similar circumstances? They use very specific methods, but the core idea is always comparison. For example, if you're selling tangible property like our widgets, they might use the comparable uncontrolled price method or CUP.
TUP.
Yeah, they literally look at what unrelated parties sell identical or similar widgets for in the open market. For something intangible like royalties for using a patent, they'd use a similar concept, maybe the comparable uncontrolled transaction method or CUT. There are other methods too, like resale price, cost plus, comparable profits.
Hmm.
The key is finding that objective market-based price to compare against.
And when does this usually trigger an IRS adjustment? What kind of situations raise red flags?
Well, it often comes up when a U.S.-based taxpayer is involved in transactions, transferring property, making loans, sharing costs, providing services with a foreign affiliate, especially if that affiliate isn't subject to U.S. tax or doesn't file a consolidated U.S. tax return. That's where the potential for income shifting really exists.
That's a lot of power and oversight. Can companies do anything proactively to show they're playing fair? Or if a dispute arises, how can they resolve it without it turning into a huge battle?
Absolutely. And it's important because the IRS's authority is broad. They can make adjustments even if the income shifting was, inadvertent, not deliberately evasive. So to avoid penalties, companies really should prepare and document what's called a Section 482 study or a transfer pricing study.
A study.
Yeah, this study uses those recognized pricing methods we mentioned to demonstrate that their internal prices were reasonable and met the arm's length standard. Crucially, it needs to be completed by the time they file their tax return. There are also rules where penalties might be avoided for transactions solely between foreign corporations, unless that somehow impacts U.S. income down the line.
Can companies fix their own mistakes if they realize they priced something wrong?
Yes, a controlled taxpayer can adjust prices on a timely filed tax return to reflect arm's-length pricing. But interestingly, they generally cannot use these adjustments to decrease their taxable income on an untimely or amended return.
Ah, okay. And for disputes?
There are formal pathways. One is called competent authority. This is a process where the taxpayer essentially asks the IRS and the tax authority of the other country involved to work together.
Like a negotiation.
Kind of. They collaborate to determine an appropriate transfer price. The big goal here is to prevent the company from being taxed twice on the exact same income, once by the U.S. and once by the foreign country. And even more proactively, there's the Advanced Pricing and Mutual Agreement Program, or APM.
APMA.
Right. This is the IRS's program for resolving actual or potential transfer pricing disputes in advance, before they even happen. Companies in the IRS, often with the foreign tax authority involved too, agree ahead of time on a transfer pricing method, the comparable companies to use, the years it will apply to, how adjustments will be made. It's a very cooperative process. The IRS might concede on some points if the taxpayer agrees on others. It provides a lot of certainty for global businesses planning ahead.
Okay, so setting those internal prices right is absolutely crucial. But even before we get to pricing, how do countries decide who gets to tax what income and where that income actually comes from in the first place? It really sounds like location, location, location.
It absolutely is. First, you generally need to establish a sufficient connection to a country for that country to tax your business income. This often involves the concept of a permanent establishment.
Permanent establishment. Okay, sounds official.
It is. It basically means a corporation is conducting business in a foreign country on a regular basis, has a fixed place of business there, like an office or factory, and operates its business through that location. This usually covers things like foreign branches and foreign subsidiaries. But the specific rules for what exactly constitutes a permanent establishment can get nuanced and are often spelled out in detail in tax treaties between countries.
All right, so once you have that connection, that permanent establishment, what then? How is the entity itself viewed?
Good question. Then we need to classify the entity. One option is a foreign branch. Think of this as an unincorporated extension of a domestic, say, U.S. corporation. It's not a separate legal entity. Its profits or its losses are generally taxed immediately by both the foreign host country and the U.S.
Immediately, so no deferral.
Right, no deferral for a branch's profits. This can actually be good for the U.S. company initially if the branch has losses, because those losses can often offset U.S. domestic income right away.
Ah, interesting. Tax benefit from losses.
Exactly. And generally, the U.S. offers a foreign tax credit for the foreign income taxes paid by the branch. Also, bringing branch profits back to the U.S. usually isn't another taxable event for federal purposes, although the foreign country might impose its own branch profits tax, when the money leaves.
Okay, so that's a branch. What's the other option?
The other main option is a foreign subsidiary. This is a separate legal entity incorporated into the laws of the foreign country. Its profits are taxed by the host country, of course. But here's the key difference from a branch. Income earned by a foreign subsidiary is generally not taxed by the U.S. until those earnings are brought back, repatriated, to the U.S. parent company, usually as a dividend.
Okay, that's the deferral advantage people talk about.
That's the deferral, yes. It gives the U.S. parent significant control over when that foreign income becomes taxable in the U.S.
But there must be catches, right?
Oh, absolutely. First, any transactions between the U.S. parent and the foreign subsidiary must follow those transfer pricing rules we just discussed, the arm's length standard, to avoid penalties. And second, certain types of income earned by the subsidiary, especially passive investment income, are exceptions to deferral and are taxed immediately by the U.S. We'll definitely get into those anti-deferral rules later.
Okay, that deferral sounds like a big planning point. But going back a step, how do you even know if a dollar of income is U.S. source or foreign source to begin with? That seems pretty fundamental to this whole thing.
It truly is. These sourcing rules are absolutely critical. They determine whether income and also deductions are generated from sources within or outside the United States. For non-U.S. persons, these rules define the scope of income that the U.S. can even tax.
Right.
And for U.S. persons, they're essential for calculating things like the foreign tax credit limitation, which we'll also get to.
So how does it work? How is income sourced?
Well, the Internal Revenue Code categorizes various types of income and provides specific sourcing rules for each. It gets detailed, but the principles are key. For example, interest income. Generally, it's sourced based on the residence of the payer. So interest paid by the U.S. government or a U.S. company is U.S. source. Interest paid by a French company, that's foreign source.
Okay. Payer's location for interest. What about dividends?
Dividends are similar, usually sourced based on the residence of the corporation paying the dividend. U.S. corporation pays a dividend. U.S. source, foreign corporation pays, foreign source. Generally.
Makes sense. What about income from working or rent or royalties?
Those often work differently. Compensation for personal services is sourced where the services are actually performed. Work in the U.S. source income. Work abroad, foreign source. There's a small exception for non-resident aliens here briefly, but that's the main rule. Rents and royalties are typically sourced where the underlying property is located or used. Rent from a building in the U.S. source. Royalties for using a patent in the U.S. source. It doesn't matter who pays it.
Location of the property or the use. Okay. And selling stuff, like inventory.
Selling inventory property has its own rules, too. For example, if you purchase inventory outside the U.S. and then sell it within the U.S., that income is generally U.S. source. The place of sale matters. Disposing of U.S. real estate, definitely U.S. source. Let's maybe walk through that M&E Core example from our notes to make it concrete. Remember, they're a U.S. company with operations here and in France.
Yeah, let's do it.
Okay, first item, $5,000 dividend income from a U.S. corporation.
Okay. Payer is U.S. core, so U.S. source.
Exactly, U.S. source. Next, $10,000 interest income from a loan they made to their French subsidiary.
Payer is French, so foreign source.
Perfect, foreign source. Now, $17,000 interest income from a loan to their U.S. subsidiary.
Payer is U.S. again, back to U.S. source.
You got it, U.S. source. Okay, now rent. $29,000 rental income for property they own in South Carolina, but it's paid by the French subsidiary.
Trick question. But you said rent is based on property location? South Carolina's U.S., so U.S. source.
Precisely. Doesn't matter who pays. It's U.S. source because the property's in the U.S.
Okay.
Next, $36,000 rental income for a property they own in Nice, France, paid by their U.S. subsidiary.
Same logic. Properties in France. Foreign source.
Bingo. Foreign source. Last one. $43,000 royalty income paid by their French subsidiary for a patent that's used in France.
Okay, royalty. Location of use. Used in France. Foreign source.
Excellent. Foreign source. So if we tally that up for M&E Core, U.S. source income is $5,000 dividend plus $17,000 interest plus $29,000 rent equals $51,000.
Got it.
And foreign source income is $10,000 interest plus $36,000 rent plus $43,000 royalty equals $89,000.
Wow. So it really highlights how the type of income dictates the rule. Sometimes it's the payer's location, sometimes it's the property's location, or where an activity happens.
Exactly right. It's a very specific framework that determines where income belongs for tax purposes, and that has huge implications down the line.
Okay, so we've figured out where the income is sourced. Big picture now. How does the U.S. generally approach taxing income earned globally compared to how other countries do it? Is everyone sort of on the same page, or is it different systems?
It's generally different systems, though there's been some convergence lately. Broadly speaking, there are two fundamental approaches to international taxation. The U.S. has traditionally operated under a worldwide tax system,
Worldwide, meaning?
meaning U.S. citizens and residents and historically U.S. corporations are generally subject to U.S. tax on their entire income, their worldwide income, regardless of where on the planet it's earned.
Okay, tax everything, everywhere.
Pretty much. Now, most other developed nations, especially those in the Organization for Economic Cooperation and Development, the OECD, they primarily use what's called a territorial tax system.
Territorial,
Yeah,
sounds like, just within their borders.
exactly. Under a pure territorial system, a nation primarily taxes its citizens and residents only on income earned inside its own borders. Income earned outside the country, foreign source income, is often not taxed by the home country at all, or it's effectively exempted, sometimes called source country taxation.
So two very different philosophies.
Very different. But here's a really significant point. The big U.S. tax reform in 2017, the Tax Cuts and Jobs Act, or TCJA,
TCJA, yeah, heard a lot about that.
it actually introduced provisions that moved the U.S. corporate tax system much closer to a territorial-style approach. It wasn't a full switch, but a major shift.
How so?
Well, one key example we'll discuss more is that it allows certain U.S. corporations to take a 100% deduction for dividends received from certain foreign corporations they own.
100% deduction, meaning the dividend isn't taxed in the U.S. at all.
Effectively, yes.
Yes.
It exempts that income from U.S. taxation when it's brought back. That's a very territorial concept. It fundamentally changed the game for how U.S. multinationals think about bringing foreign profits home.
Interesting shift. And what about foreigners, non-U.S. people or companies earning income here?
Right. For foreign individuals and entities, U.S. taxation generally requires some kind of connection or nexus to the country. We have specific rules defining what constitutes substantial presence for individuals, or when income is considered effectively connected to a U.S. trade or business. We'll definitely unpack those inbound rules later.
Okay. But going back to the U.S. worldwide system, if the U.S. taxes worldwide income for its citizens and historically its companies, but foreign countries also tax the income earned within their borders, isn't there a huge risk of the same dollar getting taxed twice, once abroad, once here? How is that fair? How do governments handle that?
That's exactly the core problem that international tax systems have to solve, avoiding double taxation. It would cripple global business otherwise. Under a worldwide tax system, like the U.S. traditionally had for corporations and still has for individuals, the primary tool to mitigate this is the foreign tax credit, often called the FTC.
Foreign tax credit, FTC.
The basic idea is straightforward. The U.S. allows its taxpayers, citizens, residents, corporations to take a credit for income taxes they've paid to a foreign government directly against their U.S. tax liability on that same foreign income.
So dollar for dollar offset. If I pay $30 in foreign tax, my U.S. tax bill goes down by $30.
Almost, but there's a crucial catch. The credit isn't unlimited, it's capped. This is the FTC limitation.
Limitation. Okay, why?
The credit is limited to the amount of U.S. tax that's actually attributable to the taxpayer's foreign source income. The formula is basically your pre-credit U.S. tax on total taxable income multiplied by your foreign source taxable income, your total taxable income worldwide.
Huh. Okay, so you can only get a credit up to the amount the U.S. would have taxed that foreign income anywhere.
Okay. This prevents a taxpayer from using, say, very high foreign taxes paid in one country to reduce their U.S. tax liability on their domestic U.S. income. The credit is only meant to offset U.S. tax on foreign income.
Got it. Makes sense.
Now, it gets even a bit more layered. To prevent companies from gaming the system, for example, cross-crediting high taxes on active business profits against low-taxed passive investment income, the FTC limitation has to be calculated separately for different categories, or baskets of income.
Separate baskets, like what?
Things like passive category income, interest, dividends, etc. General category income, mostly active business profits, foreign branch income, and that new category we mentioned, global intangible low-tax income, or GILTI.
Wow, okay, so you run that limitation calculation for each basket.
You do. The formula is the same, but the numerator, the foreign source income part, is just the income within that specific category. It ensures the credit aligns properly with the type of income that generated the foreign tax.
And what kind of foreign taxes actually qualify for this credit? Can I credit my foreign property taxes?
Good question. No. Generally, only foreign income taxes qualify, or taxes paid in lieu of an income tax under specific circumstances. Things like foreign sales taxes, value-added taxes, VAT, property taxes, or customs duties typically do not qualify for the foreign tax credit.
Only income taxes. Okay. And is taking the credit always the best move?
Not necessarily.
Mhm.
Taxpayers actually have a choice each year. They can elect to deduct foreign income taxes paid instead of claiming the credit. A deduction just reduces your taxable income, while a credit directly reduces your tax liability.
So why deduct?
Well, sometimes a taxpayer might be in a situation where they can't fully utilize the foreign tax credits due to the limitation rules. In that case, taking a deduction might provide a better overall tax result, even though a credit is usually more valuable dollar for dollar.
Interesting choice. Okay, so that's the FTC, the main tool for worldwide systems.
Yeah.
What about under the more territorial approach like the U.S. is moving towards for corporations? You mentioned that dividends receive deduction, the DRD.
Yes, exactly. Under a territorial tax system, or a system moving in that direction, the primary mechanism for mitigating double taxation on corporate earnings is often a participation exemption, or, as the U.S. implemented it, a dividends received deduction, DRD.
Participation exemption, DRD, how does that work differently?
These provisions essentially allow a taxpayer, typically a corporation, to either entirely exempt certain foreign income from domestic taxation or to take a large deduction like the 100% DRD in the U.S. against dividend income received from foreign sources. The key difference from the FTC system is that under a participation exemption or 100% DRD, there are usually no residual U.S. taxes imposed on that repatriated income, even if it was earned in a country with a very low tax rate or even a zero tax rate.
Ah, so the FTC tries to level the tax up to the U.S. rate, but the DRD just says this income is exempt here.
That's a good way to put it. For U.S. corporations specifically, the TCJA allows this 100% DRD for foreign-source dividend payments if the U.S. corporation owns 10% or more of the dividend-paying foreign corporation and meets a holding period. This means generally no additional U.S. tax is imposed when those profits are brought back as dividends.
But you said there were exceptions, right? You can't just bring everything back tax-free.
Correct. There are important guardrails. First, you cannot claim both the 100% DRD and a foreign tax credit or deduction for the underlying foreign taxes paid on those dividends. It's one or the other.
Makes sense.
And critically, certain types of income that are subject to the U.S. anti-deferral rules, things like that, Subpart F income we mentioned, or GILTI, or income invested back into U.S. property, or income hit by the one-time transition tax, those amounts are generally not eligible for the 100% DRD. The U.S. still wants to tax that income currently.
Okay, this is getting into a complex web of strategies and counter-strategies, which leads back to a question. With this deferral potential for subsidiaries and now this 100% DRD for bringing some profits back, what's really stopping U.S. companies from just parking all their profits, especially easily movable ones, in super low-tax foreign subsidiaries and maybe never bringing them back or only bringing back the DRD-eligible amounts? How does the U.S. prevent indefinite avoidance?
That is the central challenge that the U.S. tax system grapples with in the international space, and it's precisely why the U.S. tax code has a powerful and frankly quite complex set of anti-deferral rules.
Mm.
The general rule might be deferral for active foreign subsidiary income, but these anti-deferral rules act as major exceptions. They're specifically designed to prevent U.S. taxpayers from artificially shifting income to low-tax jurisdictions or deferring U.S. tax indefinitely on certain types of income that are considered easily manipulable or passive.
Okay, so what are these key anti-deferral weapons in the IRS arsenal?
All right, let's break down the main ones. First, there's the passive foreign investment company regime, known as the PFIC rules.
PFIC.
Like a foreign entity gets tagged as a PFIC if it meets either an income test or an asset test. Basically, if 75% or more of its gross income is passive income, think dividends, interest, rents, royalties, capital gains, or are, if at least 50% of its assets are assets that produce passive income.
So if it looks like an investment holding company.
Pretty much. If a foreign company is primarily just holding investments rather than running an active business, and if a U.S. person is a shareholder in a PFIC, they generally face immediate U.S. taxation on their share of the PFIC's earnings, even if not distributed. There are a few ways this tax is calculated, but the point is to eliminate the benefit of deferral for these passive investments held offshore.
Got it. Passive income gets taxed now. What else?
Then we have the very significant controlled foreign corporation rules, usually referred to as the CFC rules or the Subpart F regime.
Subpart F, heard that term before. It sounds ominous.
It can be for tax planning. A foreign corporation is classified as a CFC if U.S. shareholders, and here a U.S. shareholder means a U.S. person owning 10% or more of the stock, collectively own more than 50% of that foreign corporation's stock by vote or value.
So U.S. controlled.
Exactly. And the purpose of the Subpart F rules is to discourage U.S. taxpayers from accumulating certain types of mobile income, what the rules often call bad income in these CFCs, especially if they're located in low-tax jurisdictions, purely to defer U.S. taxes.
What counts as bad income under Subpart F?
It primarily targets certain types of passive income like dividends, interest, rents, and royalties, similar to PFIC. But it also targets certain types of active income that are considered easily shifted between related parties. This is called foreign-based company income. Think about things like sales or services income from transactions involving related parties located outside the CFC's country of incorporation.
Ah, so trying to prevent using a CFC as just a routing hub.
Precisely. If a CFC earns this Subpart F income, its 10% U.S. shareholders are generally taxed currently on their pro rata share of that income, whether it's distributed or not. No deferral, and importantly, no 100% DRD is available for Subpart F income when it is eventually distributed.
Okay, so what if a company is both a PFIC and a CFC? Which rules win?
Great question. There's an overlap rule. If a foreign corporation meets the definitions of both a PFIC and a CFC with respect to a U.S. shareholder, the Subpart F rules take precedence. So let's say U.S. company ABC owns 12% of Foreign Core D. Foreign Core D is 72% owned by various U.S. shareholders, making it a CFC, and maybe 80% of D's income is passive, making it also meet the PFIC income test.
Right.
In this case, because D is a CFC for ABC, the Subpart F rules apply first. ABC will have to include its share of D's passive income, which is Subpart F income, and its U.S. taxable income currently. The PFIC rules essentially don't apply to ABC for that income. Subpart F is generally the primary anti-deferral regime for U.S.-controlled foreign companies.
Okay, that clarifies the hierarchy. Subpart F is a big one. What came next? You mentioned GILTIR from the TCJA.
Yes, GILTI, Global Intangible Low-Taxed Income. This was a major brand new addition in the TCJA, effective from 2018.
GILTIR, what's the target here? Subpart F already hits passive income.
GILTI aims at something different. It's essentially a minimum tax on certain active business income earned by CFCs that is subject to a low foreign tax rate. Its main goal was to reduce the incentive for U.S. companies to shift even their active operations, and especially their valuable intangible assets like patents and brands, to very low tax jurisdictions, just to avoid U.S. tax.
So it's like a backstop for active income that isn't caught by Subpart F.
Exactly. It's a broad-based inclusion. U.S. shareholders of CFCs are taxed currently on their share of GILTI, much like Subpart F income. However, for U.S. corporations, not individuals, there's a special deduction allowed against GILTI. For 2018-2025, it's a 50% deduction.
50% deduction. So it's taxed, but at a lower rate.
Right. With the current 21% U.S. corporate tax rate, a 50% deduction results in an effective tax rate of 10.5% on GILTI inclusions for corporations. It's not zero, but it's lower than the full domestic rate.
How is GILTI calculated? Is it complex?
The calculation itself has several steps. Basically, you take the U.S. shareholder's share of the CFC's net income, excluding certain things like Subpart F income that's already taxed. Then you reduce that by an amount equal to 10% of the CFC's average adjusted basis in its depreciable tangible property used in its business, minus some net interest expense. This 10% return on tangible assets is considered a sort of normal return. Anything above that is potentially GILTI.
So income associated with tangible assets gets a pass, but the excess potentially linked to intangibles gets hit.
That's the idea behind it. For example, if Hughes Corp, a U.S. company, owns 15% of EKM Corp, a CFC, EKM has $1 in net income, then is Subpart F, and $2 in average tangible asset basis. Hughes' share of income is $150K. The deemed return on assets is 10% of 2x $200K. Hughes' share of that is 15%. $200 is $30. So Hughes' GILTI on inclusion is $150 share of income, $30 share of deemed return. It was $120K. Then Hughes Corp could potentially take a 50% deduction, $60K, against that $120K inclusion.
Okay, that example helps. So GILTI is a big deal for CFCs with low-taxed active income, especially income from intangibles. What other anti-deferral rules are there?
Another important set relates to earnings invested in U.S. property.
Investing earnings back in the U.S., why is that bad?
It's not inherently bad, but these rules are designed to prevent U.S. taxpayers from effectively repatriating earnings from a CFC in a way that avoids U.S. tax without actually paying a dividend, which might be taxable, especially before the 100% DRD. Think about it. Instead of paying a dividend, the CFC could just make a large loan to its U.S. parent company, or buy stock in the U.S. parent, or buy tangible property located in the U.S. The money is effectively back in the U.S. system.
Ah, so it's a way to access the cash without triggering a taxable dividend.
Exactly. So the rules treat certain increases in the CFC's investment in U.S. property as a deemed dividend distribution to its U.S. shareholders, triggering current U.S. taxation.
What counts as U.S. property here?
It includes things like tangible property located in the U.S., stock of a related domestic corporation, obligations like loans of a U.S. person, and rights to use patents, copyrights, or similar intangibles in the United States. So, for example, if Blue Corp, a CFC, makes a $1 million loan to its U.S. parent company during the year, and that represents an increase in its earnings invested in U.S. property, assuming it had earnings to cover it, the U.S. parent might have to recognize a taxable deemed dividend for that amount, even though it received a loan.
So it's like a constructive repatriation trigger. If the money comes back, even indirectly, it gets taxed now.
That's the concept. Now, with all these rules causing current taxation, Subpart F, GILTI, U.S. property investments, what happens when the CFC actually distributes those earnings later as a real dividend?
Yeah, do you get taxed again?
Thankfully, no. This is where the concept of previously taxed income, PTI, comes in. If a CFC's earnings have already been taxed to its U.S. shareholders under these anti-deferral rules, those specific earnings create PTI accounts. When those amounts are later distributed as actual dividends, they can generally be excluded from the U.S. shareholders' income. It prevents double or even triple taxation on the same earnings.
Okay, that's good. A mechanism to track what's already been taxed.
Very important. Now, two more big items related to the TCJA transition and base erosion. First, the transition tax.
Right, you mentioned this is a one-time thing.
Yes. As part of the big shift in 2017 towards the more territorial system and the 100% TRD, Congress decided it needed to deal with all the offshore earnings that U.S. companies had accumulated over decades under the old deferral system, which hadn't yet been taxed by the U.S. So the TCJA imposed a mandatory one-time deemed repatriation tax. It applied to 10% U.S. shareholders of CFCs. All those previously untaxed deferred foreign earnings going back potentially decades were deemed to be brought back to the U.S. and were subject to a one-time tax.
Wow, how much tax?
It was a bifurcated rate. Earnings held as cash and cash equivalents were taxed at 15.5%. All other earnings, like those reinvested in active business assets, were taxed at 8.0%. Taxpayers could elect to pay this tax over 8 annual installments. It was a huge revenue generator for the government at the time.
A massive cleanup of past deferred earnings.
Yeah.
Okay. What's the last big one? BEAT.
Yes, BEAT, the base erosion and anti-abuse tax. This is another minimum tax created by the TCJA, but it targets a different behavior.
Base erosion sounds like companies shrinking their U.S. tax base.
Exactly. DEAT applies to large U.S. corporations, generally those with average annual gross receipts of at least $500 million, that make a significant amount of deductible payments to related foreign affiliates.
Like what kind of payments?
Things like interest, royalties, certain service payments, payments that could potentially be used to strip earnings out of the U.S. tax base and shift profits to lower tax foreign affiliates.
So how does BEAT stop that?
It works by calculating a modified taxable income. For this calculation, the corporation has to add back many of these deductible payments made to foreign-related parties. Then, a minimum tax rate, which started at 5%, rose to 10% for 2019-2025, and goes to 12.5% after that, is applied to this modified base. If the BEAT calculation results in a higher tax than the corporation's regular tax liability after certain credits, the corporation has to pay the difference as BEAT. It essentially puts a floor on how much these large companies can reduce their U.S. tax liability through these related party payments. There are exceptions, like for cost of goods sold, and a de minimis rule if the base erosion payments are low relative to total deductions.
So it's a check on using internal payments to excessively lower U.S. tax.
That's the core idea. Now, on the flip side, the TCJA also introduced an incentive for keeping certain income in the U.S., the Foreign-Derived Intangible Income, FDI deduction.
FDI sounds like the opposite of GILTI.
Kind of. While GILTI taxes foreign intangible income, FDII provides a deduction for certain income derived from exploiting intangibles from the U.S. to foreign markets. It's designed to incentivize U.S. companies to locate their intellectual property and export activities here in the U.S.
How does it work? What income qualifies?
A U.S. corporation, it has to be a C Corp, can get a deduction for a portion of its income that's considered FDII. This generally includes income from selling property to any non-U.S. person for foreign use. providing services to any person located outside the U.S., or selling property to a related party who then sells it to an unrelated non-U.S. person for foreign use. Similar to GILTI, there's a calculation involving a deemed return on tangible assets. The deduction amount is 37.5% for years before 2026, which, with a 21% corporate rate, results in a lower effective tax rate, 13.125%, on this qualifying export-related income.
So it makes exporting from the U.S. more tax advantaged.
That's the goal. And one last specialized incentive to mention briefly is the Interest Charge Domestic International Sales Corporation, or ICDIS.
I see.
This is a long-standing provision, not new in TCJA, but still relevant. It can be beneficial for U.S. domestic companies, often smaller, closely held ones, that manufacture or distribute U.S.-made goods for export. Essentially, the U.S. exporting company sets up an ICDISE, which is a separate tax-exempt entity on paper. The exporter pays a commission to the ICDISE based on its export sales. This commission is a deductible expense for the exporter, lowering its corporate tax.
And the ICDISE is tax exempt.
The ICDISE itself generally doesn't pay tax on the commission income. When it distributes that commission income to its shareholders, who are often the same owners as the exporting company, those shareholders pay tax, but typically at the lower qualified dividend or long-term capital gain rates rather than ordinary income rates.
So it converts some export profit from being taxed at higher corporate ordinary rates to lower dividend rates.
That's the main benefit. It effectively allows the owners to get a tax break on a portion of the export profits. There are limits on how much commission can be paid based on export sales or net income.
So pulling this all together, Subpart F, GILTI, BEAT, U.S. property rules are sticks, trying to prevent income shifting out. FDII and ICDSC are carrots, trying to encourage keeping activity and exports here. It's a really complex web.
It absolutely is. All these rules we've just run through, anti-deferral like PFIC and Subpart F, the newer GILTI and BEAT, the deemed repatriation rules like U.S. property and the transition tax, plus the incentives like FDII and ICDSC, they're all part of this comprehensive, constantly evolving strategy by the U.S. to manage international income flows. It's about balancing competitiveness with protecting the U.S. tax base in a globalized economy.
All right, that covers U.S. companies going out. Let's flip the coin. What about foreign individuals or companies coming in? People or businesses wanting to invest or operate in the U.S. How does the U.S. tax them?
Right, these are inbound transactions. The general principle is that the U.S. taxes foreign persons, that includes non-resident alien individuals, foreign corporations, foreign partnerships, trusts, estates, primarily on their U.S. source income. Remember our sourcing rules from earlier? They're key here too.
Okay, U.S. source income. How is it taxed?
It depends on the type of U.S. source income. It generally falls into two broad categories for foreign persons. First, there's business income. If a foreign person is considered engaged in a trade or business within the United States, ETBUS is the acronym sometimes used, then their U.S. source income that is effectively connected with that business, ECI, is taxed on a net basis.
Net basis, meaning they get deductions.
Exactly. Gross income from that business minus allowed deductions and expenses related to it. And this net income is taxed at the same U.S. graduated tax rates that apply to U.S. persons. Yeah. So a foreign corporation with a U.S. branch pays the standard U.S. corporate tax rate on its branch profits. They file specific U.S. tax forms, like Form 1120-F, for a foreign corporate branch.
So if British Bunting Inc. from our notes has a U.S. branch in Austin making $100 in gross profits with $40 K COGS,
then it's effectively connected income. Its U.S. taxable income would be $60K, $100K, $40K, and that $60K would be subject to the regular U.S. corporate tax rate.
All right. Tax like a U.S. business on business income. What's the second category?
The second category is non-business income, which is typically passive investment type income. Think U.S. source dividends, interest, royalties, certain rents.
How is that taxed?
This type of income, often referred to as FDAP income, fixed, determinable, annual, or periodic, is generally taxed very differently. It's taxed on a gross basis.
Gross basis, no deductions at all.
Correct. No deductions allowed against FDAP income. And it's taxed at a flat statutory withholding rate of 30%.
30%? Wow. Who collects that?
The responsibility falls on the U.S. person making the payment to the foreign person. They are required to withhold the 30% tax from the payment and remit it to the IRS. Yeah. So if a U.S. company pays a dividend to a foreign shareholder, it typically has to send 70% to the shareholder and 30% to the IRS.
30% seems high. Does that always apply?
That's the statutory rate. But this is where tax treaties become incredibly important. Many U.S. tax treaties significantly reduce or sometimes even eliminate this 30% withholding tax on specific types of FDAP income, like dividends and interest paid to residents of the treaty country. Treaty rates of 15%, 10%, 5%, or even 0% are common.
Ah, so treaties provide relief on that withholding tax.
Huge relief, yes. There's another major withholding regime, too, called ATC, the Foreign Account Tax Compliance Act.
ATC, I heard of that one too, related to bank accounts.
Yes, ATISA imposes its own 30% withholding tax, but its target is different. It's imposed on certain U.S. source payments made to foreign financial institutions, like banks, or other foreign entities, if they fail to comply with specific information reporting requirements about their U.S. account holders or owners.
So it's not a tax on the income itself, but a penalty for not sharing information.
Exactly. Its purpose is to combat tax evasion by U.S. persons who might be hiding assets or income in foreign accounts or entities. It uses the leverage of U.S. withholding to force foreign institutions to identify and report on their U.S. clients to the IRS.
Okay, complex withholding systems. Now, what about foreign individuals? You mentioned they can sometimes be treated as U.S. residents for tax purposes. That sounds like a big shift. How does that happen if they're not a citizen or a green card holder?
Yes, this is a really crucial point for individuals spending time in the U.S. A foreign individual can absolutely be treated as a U.S. resident for tax purposes, even without citizenship or a green card. And if they are, remember, they become subject to U.S. tax on their worldwide income, not just their U.S. source income.
Worldwide income, that's huge.
Yeah.
So how do they become a tax resident?
There are two main tests besides actually having a green card. The first is the green card test itself. If you are a lawful permanent resident of the U.S. at any time during the year, you are a U.S. tax resident. Simple enough.
Okay, what's the other test?
The other one is the substantial presence test. This is based purely on physical presence, on the number of days spent in the United States.
How many days?
It's a two-part test. First, the individual must be physically present in the U.S. for at least 31 days during the current calendar year.
Okay, 31 days.
And second, the total number of days they were present in the U.S. during a 3-year look-back period must be at least 183 days, calculated using a specific weighted average.
Weighted average? How does that work?
You count all the days present in the current year, multiplied by 1, plus 1/3, 13, of the days present in the immediately preceding year, plus 1/6, 16, of the days present in the year before that.
Huh. So recent presence counts more heavily.
Exactly. If that weighted total reaches 183 days or more, and they met the 31-day test in the current year, they're generally considered a U.S. resident for tax purposes for that current year.
Let's try that example again. Esther, UK citizen, no green card. She spent 122 days in the U.S. in 2023, 122 days in 2022, and 122 days in 2021. Is she a resident in 2023?
Okay, let's calculate. First, did she meet the 31-day test in 2023? Yes, 122 days is more than 31.
Check.
Now, the 183-day weighted test for the 3-year period, ending in 2023. Current year, 2023. 122 days, 1 equals 122 days. Preceding year, 2022.
Yeah.
122 days, 13 equals 40.67 days, approx.
Year before 2022, it gives 20.33 days.
Bingo. So even though she never spent more than about 4 months here in any single year, under the substantial presence test, Esther would be treated as a U.S. resident for tax purposes in 2023.
Wow. That could catch a lot of people, frequent business travelers, people with vacation homes here.
It absolutely can. There are some exceptions, like for students, diplomats, or people with closer connections to other country, but the basic test is purely mechanical based on days. There's also a way for someone to make a first-year election to be treated as a resident if they meet certain criteria, but the substantial presence test is the main one.
That's a really important point for any non-citizen spending significant time stateside. Okay, so what if someone, an individual or even a company, decides they've had enough of the U.S. tax system and want to leave entirely, renounce citizenship, or move the company headquarters? Are there special rules for that kind of exit?
Oh, yes. The U.S. definitely has rules for that. It's called expatriation, and there are specific regimes for both individuals and corporations choosing to leave the U.S. tax net.
Okay, let's start with individuals. Someone renounces their U.S. citizenship. What happens then?
For individuals, we have what's often called the exit tax. Officially, it's a mark-to-market regime.
Mark-to-market. Sounds like they value everything.
Pretty much. But first, it only applies to individuals who are considered covered expatriates.
Covered expatriates. Who gets covered?
An individual generally becomes a covered expatriate if they renounce U.S. citizenship, or, for long-term green card holders, terminate residency, and meet any one of three tests on their expatriation date, a tax liability test. Their average annual net income tax liability for the 5 preceding years was over a certain indexed threshold. It was $190,000 for 2023. A net worth test. Their net worth was $2 million or more, a compliance test. They failed to certify that they complied with all U.S. federal tax obligations for the 5 preceding taxable years.
So high income, high net worth, or didn't follow the rules. If you meet any of those and renounce citizenship, you're covered.
Generally, yes. And if you are deemed a covered expatriate, the exit tax kicks in.
And what is the exit tax?
The core of it is the mark-to-market rule. All of the covered expatriate's property worldwide is treated as if it were sold for its fair market value on the day before the expatriation date.
Deemed sale of everything. Ouch.
It can be. Any gain resulting from this deemed sale is generally subject to U.S. capital gains tax in that final year. There is a significant exclusion amount applied against this gain. It was $821,000 for 2023, which can shield smaller estates or gains. But for those with substantial unrealized depreciation, it could be a very significant tax hit.
Let's use that example. Kathleen, U.S. citizen, founder of Cupcakes Inc. Her stock is worth $7 million, basis $250K. She renounces citizenship in 2023.
Okay, first, is she covered? Her net worth is $7 million, which is well over the $2 million threshold. So yes, she's a covered expatriate.
Right.
Now the exit tax. Her stock is deemed sold for $7 million. Her basis is $250K. The potential gain is $6.75 million. She gets to apply the 2023 exclusion of $821,000. So her taxable capital gain from the deemed sale is $6,750,000 minus $821,000, which equals $5,929,000. That gain is taxed in her final U.S. tax year.
Wow, nearly $6 million in gain tax just for leaving. That's a powerful deterrent.
It's designed to ensure that significant untaxed depreciation doesn't escape the U.S. tax system when someone expatriates. Taxpayers can sometimes elect to defer payment on certain assets, but the liability is triggered.
Okay, that covers individuals. What about companies trying to leave? Moving their headquarters offshore, those corporate inversions we hear about.
Yes, there are specific expatriated entity rules for corporations, too. This generally applies when a U.S. company reorganizes its corporate structure, typically putting a new foreign parent company on top, often in a lower tax country, in a way that effectively replaces the old U.S. parent. The goal is usually to reduce the overall U.S. tax burden on the group's worldwide income.
How do the rules fight that?
There are thresholds based on the ownership level that the former U.S. shareholders retain in the new foreign parent company after the inversion transaction. If the former U.S. shareholders own 80% or more of the new foreign parent, the rule is simple. The inversion is essentially disregarded for U.S. tax purposes. The new foreign parent company continues to be treated as a U.S. corporation, subject to U.S. tax on its worldwide income, just like the old U.S. parent was.
So 80% or more ownership, the inversion basically fails for tax purposes. What if it's less than 80%?
Now, if the former U.S. shareholders own 60% or more, but less than 80% of the new foreign parent, the consequences are different but still punitive. The entity might be respected as foreign, but the inverted U.S. group is denied certain U.S. tax benefits, like using net operating losses or foreign tax credits to offset any income or gain recognized as part of the inversion transaction itself, the inversion gain. It makes the transaction much less attractive.
Okay, so strict rules depending on ownership levels. Did TCJA affect this too?
Yes. The TCJA added further provisions to reduce the incentive for corporate expatriation. For example, we talked about the 100% DRD for foreign dividends. TCJA specifically denies this deduction for dividends received from these newly created surrogate foreign corporations resulting from inversions, trying to close off potential benefits.
Makes sense. Okay, this has been an absolutely incredible deep dive. We've gone through transfer pricing, sourcing, worldwide versus territorial, FTCs, DRDs, a whole host of anti-deferral rules, inbound rules, exit taxes. It sounds like an incredibly complex system with enormous potential for conflicting rules and disputes between different countries' tax authorities. Is there anything that helps bring some order, some consistency to this global tax landscape?
Absolutely there is. And that vital role is played by tax treaties.
Tax treaties, okay.
Yeah. These are formal bilateral income tax agreements or conventions that the United States enters into with specific foreign countries. Think of them as a special contract between two nations, specifically about how they will tax income flowing between them. And importantly, these treaties generally carry the same legal weight as domestic U.S. tax law. They can, and often do, modify or override the otherwise applicable U.S. tax rules found in the Internal Revenue Code for transactions involving residents of the treaty partner country.
So they create special rules for treaty partners. What kind of rules?
They serve several key functions. One of the most common is reducing those statutory withholding tax rates we talked about on non-business income, like dividends, interest, and royalties. That 30% U.S. rate might be reduced by treaty to 15%, 5%, or even 0% for payments to residents of the treaty country.
That's huge for cross-border investment.
Huge. Treaties also provide clearer, often more taxpayer-favorable definitions of concepts like permanent establishment. They establish rules to prevent double taxation by coordinating taxing rights between the two countries. They might modify the source of income rules or residency rules or provide mechanisms for resolving disputes like that competent authority process we mentioned earlier. The U.S. currently has an extensive network of these income tax treaties with approximately 60 countries around the world. They are absolutely essential for facilitating international trade and investment by providing greater certainty and preventing excessive taxation.
Wow, what a journey we've been on. From companies moving widgets across borders to individuals deciding where to call home for tax purposes, we've really seen how international tax isn't just about dry numbers. It's deeply intertwined with global business strategy, national economic policy, and fundamental questions of fairness in our interconnected world. We've unpacked the complexities of transfer pricing, explored how income gets sourced and how entities are classified. We navigated the differences between worldwide and territorial tax systems and really dug into those powerful U.S. anti-deferral rules. And finally, the crucial role of tax treaties in bringing some order. It's truly a fascinating intersection of economics, law, and global politics.
It really is. And what's so fascinating, I think, is that international tax is never static. It's an incredibly dynamic field, constantly trying to adapt to the changing realities of global commerce, new technologies, new business models. You name it, it's always this perpetual balancing act. A nation's sovereign right to raise revenue through taxes, the need to remain competitive so businesses don't just leave, and the universal goal of preventing tax evasion and ensuring some level of fairness. Understanding these foundational concepts we discussed today is just so key to grasping how global business really operates and how governments grapple with maintaining economic equity in a world where borders seem increasingly porous.
That really raises a big question for the future, doesn't it? As the global economy keeps evolving, think about digital services, remote work, cryptocurrencies, business models that barely touch physical borders. What do you, our listeners, think will be the next major challenge or perhaps the next big innovation in international taxation? How might governments need to adapt these rules we've talked about to ensure fair and effective taxation in this increasingly borderless world? Definitely something interesting to mull over until our next deep dive.